Today we are going to discuss about accounting theory and accounting research. Accounting research. So we are going to spend a small amount of time of today's session in this topic, and we have to discuss more on the topic. So I will quickly on this. So accounting research, the process of investigating the phenomena. So normally we call research means investigating a phenomena, investigating a subject matter. We have to answer some sort of questions consisting of a deductive approach and deductive reasoning and inductive reasoning. We already discussed what do you mean by deductive reasoning and inductive reasoning, right? So an accounting research may be uh, anybody can approach to research in accounting phenomena, so they can use deductive approach or deductive reasoning or inductive reasoning. So increase in the use of scientific methods in conducting accounting research. So when you look at the research databases, we can find so many researches, scientific researches in accounting, right? It involves analyzing the behaviors of rule makers. Rule makers means the regulators, the government, regulators. In Sri Lankan point of view, Sri Lanka Auditing, Accounting and Auditing Standard Monitoring Board. Preparers mean accountants, the behavior of accountants, behavior of auditors. And users mean the users of financial statements and stock market, right? So it analyze the accounting research analyze this sort of behaviors. And accounting research and scientific methods, right? Deductive and inductive reasoning is a method, as a method they are applying in accounting research. And normative and positive theories, the normative, it it tests whether it's right or wrong, good or bad. Rule of thumb we can find in normative approach, normative theories. But positive theories we can find, we want to give description, it gives explanations. Normally always it asks why and how type of questions. Global and particularistic theories, global theory mean it is applicable for all of the regions. Agency theory, stewardship theory, and corporate governance theory. It's common. It's not, and capital asset pricing model, pharma French model, theories. These are the common. It's global context. Particularistic theories. There are some researches cannot be applicable to one country to another country. So if one research has done in US, that research, that finding cannot be applied, not suitable in Sri Lankan context, right? In around the world during the COVID pandemic, stock markets are go down in many of the world countries, but in Sri Lanka, it's miracle. It's upward marketing, right? Many people are getting return in the Colombo Stock Exchange, right? So it's different, right? And some of the findings are globally applicable. Some of the findings are applicable only for a particular situation or particular country or region. Pragmatic theories, pragmatics mean practical. It can be divided into two: descriptive and psychological pragmatic approaches. Now, descriptive pragmatic approach it's view from the point of view of accountants, the preparers, And psychological pragmatic approach is view in the side of the users of the account informations. And syntactic and semantic. Syntactic means symbols, syntax, and semantic mean it's a meaning of the particular syntax. And direction in accounting research, decision model approach, NPV. So why do we calculate NPV, IRR, ARR to take some kind of decisions? So why do you make in CVP analysis, break-even point analysis? You have to make some decisions. ABC costing. Why do you do this? To make some decisions. So this is kind of these are the decision model approaches. Capital market research. You can find there are many research in the in finance. Most of them are doing research on capital market data. Why? Uh, some may ask question why Sri Lankan stock market booms during even the COVID pandemic. Around the world, most of the markets are going down. Why Sri Lankan markets are booming? It's a question. No, right? It's capital market research. Behavioral approach. Why some accountants behave in a particular manner? Why some accountants are preferred to follow international reporting standard? So some of the accountants are willing to follow a local accounting standard. So why do they? Some of the accountants, some of the management willing to get loan, some of them are willing to get more equities, some of the some of the management willing to declare dividend, some of management get invested that excess money. So this kind of behavior, why people behave like this? Agency theory, agency theory mean the companies belongs to shareholders, but actually the shareholders are not running the business. On behalf of the shareholders, management, board of directors manage the business. So during this management, the separation, management is separate entity and the ownership is a separate entity. The owners, the shareholders are called as principals, and managers, board of directors are called as agents. Sometimes directors, the board of directors are doing their business, managing the companies to get to appreciate their own benefit. So this kind of behaviors contradict with the objectives of the shareholders. So this is called agency problem, agency theory. And information economics, the money supply, balance of payment, why government stop imports, why government motivate exports, why Sri Lankan rupees continuously depreciate against US dollar, other currencies. Critical accounting, you know, uh, so they are suggesting new accounting theories, accounting models like balance scorecards and life cycle theory, target costing. So this kind of thinking, right? It's kind of theories they are give us. Decision model approach. So this asks what information is needed for making decisions. So think about break-even point analysis. It does not ask what information users want, but rather concentrate on what information is useful for a particular decisions. You think about a BEP. So in that, to calculate the BEP break-even point, you need what? You don't want all information is available there. So you want just contribution per unit, variable cost per unit, selling price per unit, fixed cost. This sort of information is enough, right, to calculate break-even point. So its orientation is normative and descriptive, right? Example, theorist advocating the range of valuation possibilities. For example, exit value. Uh, the authors are Chambers and Sterling, and current value by Bell, and retrieval value, so elements, historical cost, IJRI. So this kind of things. And for the valuation, every different authors are supposed to suggest a different approach. Two major decisions embraced by the decision model: prediction of the future cash flow. So based on the available information, they can predict future cash flow, the future profitability, analyzing the efficiency and effectiveness of management, stewardship. It's opposed to the agency problem. Stewardship means the board of directors are willing to work with the objectives of the shareholders. Capital market research, publicly traded securities. You know, the stock market. You can find almost 300 stocks, company stocks you can find, right? And public traded securities react rapidly and in unbiased manner to new informations. So many people are wonder, many researchers are wonders why the stock market, Columbus Stock Exchange, grow very rapidly. What's the reason behind? Right? It's a miracle, right? It's abnormal thing. So in Sri Lanka, you know, not on Sri Lanka, all over the world economies are going down, but in Sri Lankan stock market is booming. Right? Sri Lankan economy is going down, but stock market is booming. It is not. It's not a real thing, right? So something is going on in the market. Somebody is dominating the market. It gives signals. So who is dominating in the market? The question, right? So somebody want the researchers are willing to get answer for this question. So really it's a problem. The system of efficient market hypothesis. You might studied about efficient market hypothesis. Weak form of efficient market, strong form of efficient market, semi-strong form of efficient market. Right? So this is currently subject to many challenges, inductive in nature, right? You have to create new things. You have to observe many things. You have to observe for about long period of time, and you have to find a common pattern. From that, you have to formulate a hypothesis, and then you have to develop a theory. Behavioral approach: how people are behave. Focus is on how users make decision and what informations they need. So this is the point of view of the users, right? This is the descriptive positive approach in nature, behavioral approach. So that's all about this presentation. Now we move to the next chapter. Right, next chapter is generally accepted accounting principles. It's from this slides onwards, this session onwards. The words are very familiar with you, right? Generally accepted accounting practice principles. You might study it, accounting concepts, accounting principles. You know, accounting concepts and accounting principles. It's very familiar to you, right? Not like the previous sessions. You can in the previous session you have encountered with new terms, new concept. Sometimes it may be difficult to understand. That's past. Right now we move to the next section, accounting concept and accounting principles. It's coming under the generally accepted accounting principles. You know, the basic accounting principles, no? Right. And now we'll start from here. So accounting is a language of business, which means that accounting is a model of communications. When you read financial statements, it's the statements are try to give something, try to give some information about the organizations. When you look at the organization's balance sheet, you can you can evaluate the capacity of the company. You can decide whether it's a big company or small company, small performing company, based on their income statements. You can judge, you can have a judgment on that companies. So it's a language, it gives some information. So accounting is a language of business, which means that accounting is a media of communication. To make the language convey the same meaning to all people, accountants all over the world have developed certain rules, procedures, conventions, which are often called as generally accepted accounting principles. Right? It's generally accepted. I mean, it's accepted by almost everybody in the world. If you're able to prepare, if you're able to understand the statement, financial statement from Sri Lankan context, definitely you're able to understand a report presented by a company in USA, a company in USA, a company in China, right? So wherever in the world, the accounting concepts are almost equal. Most most of the accounting concepts are practiced by all the people around the world. So that kind of accounting principles, accounting concepts are called generally accepted accounting principles. You can see balance sheet in Sri Lankan point of view, it's almost same the balance sheet published in India. Balance sheet income statement published in China, in Russia, in Ukraine, right? In Canada. So the statements are almost same because everybody of them are accepted some accounting principles. So that's why you're able to understand the statement also. So generally accepted accounting principles represent a consensus view by the profession of good accounting practices and procedures. So this is language is able to understand by the accounting professions, not by everybody. This principles able to practice by only professional accountants. Thus, accounting principles may be defined. It's defined as the rule of actions or conduct. The rules, accounting rules. Sometimes it called as accounting principles. As the rule of actions or conduct which are adopted by accountants universally all over the world while recording the transaction. So you know the rules. You are the accountancy specialized students. You know how to enter a particular transaction. So you follow the unique rule. It's common. It's practiced by everybody all over the world. These rules are not differ person to persons. It is not heterogeneous. It's homogeneous. The accounting treatments for a transaction are almost equal, and accounting principle may be defined as those rules of actions or conduct which are derived from experience and practice. You know, these accounting rules are coming from the experience and practices learned by mistakes, trial and error methods. For a long period of time, the people are practicing accounting and they are find the best way of dealing with transaction accountings. So those rules of actions or conduct which are derived from experience and practice, and when they prove useful, they are accepted as principle of accounting. And is defined as a term used to describe broadly the body of principles that governs the accounting for principal transactions underlying the preparation of a set of financial statements. In simple terms, a GAAP, generally accepted accounting principles, are the rules to be followed by accountants to record a transaction or event. So this kind of thing stuff is practiced by professional accountants all over the world. The generally accepted accounting practices are, however, not rigid. It's not concrete one. It's not complex one. They are subject to change. Accountant A can follow the straight line method for depreciation. Accountant B may prefer to follow reducing balance method. Right? It's subject to change. It's not a concrete one. So they have evolved in order to deal with a particular problem experienced by a preparer, it's been accountant or regulators, and users, rather than to reflect some theoretical idea. So the ultimate objective of this gap is not to produce theories, and it gives some fundamental ideas, the rules to the accountants as well as the users to understand the actual things to understand. So generally accepted accounting principles is according to the American Institute of Certified Public Accountants. The principles, the GRAB means the principles which have substantial authoritative support become a part of generally accepted accounting principles. In basic terms, we can say so rules, so principles, so basic ideas to be followed in dealing with accounting transactions. So they represent the best possible guidelines, the best possible guidelines based on reasons and observations. Reasons being the logical arguments and observations, and have been developed by accountants to enhance their usefulness of accounting data in ever-changing society. So the GAP provides the best possible guidelines, sometimes we call as the best practices to be followed by accountants. So these best practices, best guidelines are developed based on the logical reasoning and observations. So these best practices are developed by institutions, professional institutions like in Sri Lanka, for example, Institute of Chartered Accountants of Sri Lanka. Right? So these institutes are bodies representing accounting professions. They are developing the best practices. So it is in the process of evaluation and change. Evaluation, right? It's grow all the time. General acceptance of accounting principles usually depends on how well it meets the following criteria. Number one is relevance. It should be relevant, right? It should be relevant to take decisions. It should be relevant, right? It's been usefulness to the stakeholders. Whoever they want to take decisions, the statements, the gap should be provide informations to take decision, to take timely decisions. Objectivity, it should not have any bias, right? Objectivity is not subject to personal bias. And feasibility, possible. Applicability without undue complexities and cost. Right? It has two things. Right? Postulates and principles. Right? The basic concept underlying history of accounting, it has two things: postulates and principles. Right? Basic concept underlying historical cost accounting. Basic concept on underlying historical cost accounting. First one is postulates. First one is postulates. The second one is principles. There are two categories, right? First one is postulates and second one is principles. Postulates are generally defined as a basic assumptions. The basic assumptions. So you might study it. You may study it in the beginning. When you prepare accounts, when you record transaction, you have to keep it in mind. The owner is different from entity. The owner is different from entity. And each transaction has two consequences, duality, right? Double entry. So this and going concern, the firm is will be alive forever for foreseeable future, right? So that's sort of assumptions when we are preparing financial statements. Accountant should keep some sort of assumption in his mind. So that is called postulates. So postulates are generally defined as basic assumptions that cannot be verified. So how can you verify this kind of going concern, a duality, and separate entity concept? How? So they are basic assumptions concerning the business environment. It serves as a foundation for inferences. So when you if you fail to keep if you fail to assume the entity is different from organization, how can you prepare accounts? How can you prepare accounts? Right? So to make easier, to give more meanings, accountant should keep some sort of assumption in his mind. The second part of these principles. Principles, on the other hand, are general approaches utilized in recognition and measurement of accounting events. So second part is some kind of procedures, accounting procedures, principles. The first one is assumptions. It's called postulation. Second one is principles. You see this some small overview, right? You see accounting postulates here: going concern, time period when you prepare accounts, You have to divide the period into 12 months. One accounting period is equal to 12 months. So if you have failed this assumption, what will happen? Accounting entry, it's like two, right? Double entry. And the manager in it, you can record only measurable in terms of rupees, money. And the principles, you can find a lot of prudence, periodicity, good faith, at most good faith. So this kind of stuffs. So due to the existence of GAAP, so we can easily understand the financial statement. You can easily compare the financial statement. We can simplify in the reporting, and you can find the common format everywhere. Communication clarity reduces chances of cheating, interfirm comparison, of finding improvement area, right? So when everybody follows the same rule, same procedure, it is easier for accountants. It's a language. You see, the basic concept underlying historical accounting. So we can divide into two. The first part is postulates, the second part is principle. Under the postulates, you can find going concern concept, going concern assumption, time period assumption, accounting entity, and monetary units. So these are the assumptions. And when we talk about the principles, again, it can be divided by two. So input oriented principles and output oriented principles. Input. So general underlying rules of operations, recognition and matching. Constraining principles, conservation, conservatism, disclosure, materiality, objective or verifiability. In output oriented principles, applicable to users, comparability, and applicable to preparers, accountant. They should consistent and uniformity, right? So it's about what? Output oriented principles. These are the input oriented principles. Now we'll discuss about the first part, that is postulates. So basic concept, postulates. Under that, first we will discuss about going concern concept. So it is assumed that a business unit has a reasonable expectation of continuing business at a profit for a indefinite period of time. You have to assume that the firms will run for foreseeable, reasonable, foreseeable future, right? So it is not going to close tomorrow or next year, not like that. So accountants would assume that the company, the firms will do the operation for future, in the future, right? For foreseeable future, reasonable foreseeable future. A business unit is considered to be a going concern and not a gone concern. Not gone concern, it's a going concern. It's the first assumption. So the impact of going concern concept. So when the accountants follow the going concept assumption, so what are the impacts you can observe in accounting? Credit transactions, credit on loan basis, you can sometime buy or sometime you can sell it for credit, not cash payment, on credit basis. So credit transactions are recognized and recorded in the accounts on the assumption that business will continue in the future to settle on those dues. Credit purchase, and credit sales. You record as credit purchase, receivable, payable. It means you assume that the company will run for long period of time. Fixed assets are recorded at original cost and depreciated over time if cost model is used, without reference to its fair value and impairment. No need to show the assets at fair value if there is no immediate expectations to sell it. So normally when we record the fixed assets in the account, we take a purchase price, historical cost. Very rarely, very occasionally, we record on fair value, market price. So these are the impacts of going concern concept. Prepaid expenses are considered to be an asset on the assumption that business will continue in the future and get benefit out of such prepaid expenses. Emphasis on determination of net income rather than on the valuation of assets. Earning capacity is more significant than market value of its individual assets in judging overall worth of the business. Now we move to the second concept, periodic concept. When we prepare financial statements, we consider a 12-month GAAP. Accounting period consists of 12 months. So we report accounts for every 12 months. It's called accounting period concept. Final accounts must be prepared on periodic basis rather than waiting till the business is liquidated. Going concern concept assumes that business has a reasonable expectation of continuing the business for an indefinite period of time, and therefore it is reasonable to divide the business into accounting period, normally 1 year, so as to be able to determine financial performance and the position of the business in that accounting period. So this concept plays an important role in determining the true net income of particular accounting period. This concept also assists for the true and fair view of finance statement at a given period of time. Impact of accounting period concept on accounting. So we'll see the impact of accounting period concept. Segregating, we are separating capital expenditures from revenue expenditure. We differentiate capital expenditure and the revenue expenditure. When we occur the capital expenditure, we will charge in balance sheet, not in PL account. In case of revenue expenditure, we'll charge on PL account, not in balance sheet. Revenue expenditure will be transferred to profit and loss account of that accounting period, while the capital expenditure will be carried forward to the extent its benefit will utilize during the future accounting periods. Business entity concept. Owners are the separate entity, separate from the entity. The business and the owners are two separate entities, right? The business owner and the business are two separate entity. That's what business entity concept. So this concept implies that a business unit is a separate and distinct from the person who supplies capital to that business. Accounting equation is an expression of the balance of the business entity concept. Accounting equation is an expression of the business entity concept. Asset equal liability plus capital. Asset equal liability plus capital. However, legally, a business is not a separate unit from the owners of that business. Owners become liable to the assets and liabilities to the extent of their ownership, legal ownership. Now we'll see the impact of business entity concept on accounting. Only business transactions are recorded and no personal transaction of owners is not recorded. The transaction of the owner with the business are recorded so that true financial position and performance are determined. Capital provided, withdrawal. Uh, accountants will record only the transaction which are deal with the business entity, and the accountant will not record all the transaction made by the owner which are not related to the business, right? you know it's a basic concept, right? Well, no need much explanation on this. And money measurement concept, everything, accounts will record the things only which are only measured by in terms of money, rupees. Money is the only practical unit of measurement that can be employed to achieve homogeneity of financial data. When you observe the financial statements, everything's are in terms of rupees, US dollar. It's mean a currency unit. A business data with heterogeneous scale of quantities, unless they are measured in homogeneous unit of measurement, money, cannot be used to effectively measure the financial performance and the financial position of that business organizations. Now we'll see the impact of monetary measurement concept on accounting. Accounting records only the transactions which can be expressed in terms of money through quantitative records. We are not recording the quality of a manager, the quality of product, quality of management team, quality of employee, the qualification of employees, qualification of managers. Also manager, not, we are not reporting. It not reports how many units are produced, how many machines are there, how many furnitures are there, not like that. It records, it records only monetary value, rupees value. Realization concept. Revenue is considered as being earned on the date at which is realized, even though the payment may be received at some future date. When sales are made on credit basis, you record immediately as revenue, regardless whether you have received money or not. It's called realization concept. That is, revenue is considered as the beginning, being earned on the date when the property in goods passes to the buyer and become legally liable to pay. However, in the case of hire purchase, sales are presumed to have been made to extent of down payment, installment received, and installed dues and not received. So the hire purchase are different case. This concept is criticized by economists on the ground that unrealized gains are not considered in accounting. Sometimes they may not pay the dues. So distinction is made between holding gain and operating gain. Holding gain means when you keep an asset, you will get some sort of benefit. And operating gain mean when you sell the asset, you will get some sort of gains. But in accounting, normally records operating gains. Okay. So distinction is made between holding gain and operating gain. Holding gain arises as a result of increase in value from holding an asset, and operating gains are realized as a result of selling assets. Holding gains are not recorded because property in goods has not yet transferred, but operating gains are reported because they have resulted as a result of sale. And matching concept, this concept is based on accounting period concept. So they match revenue, with expenditures. When they calculate the profit, they have to consider revenue as well as corresponding expenditure. So this concept is basic accounting period concept, and determining a profit of a particular accounting period is essentially a process of matching the revenue recognized during the period, not prepayment, right? It not include the not prepayments, the payment during the period, the expenditure during the period, and, and the cost to be allocated to the period to obtain such revenue. So there are also situations where rebate is considered as being earned when a case is collected, regardless when the sale is made or service is rent. A proportional service, proportional service, normally they are getting advance payment before start providing service. They are getting money, so at the time of getting money they have to recognize as a profit, as a revenue. Now we'll move to the principles. Earlier we have discussed about postulates. Now we move to the principles. Conservatism, prudence, sometimes called precaution. Normally, accountants are not give preference for profits, but they are making some arrangements for losses. So accountants give more weight for loss than their profit. So anticipate no profit, but provide for all losses. So this means taking a gloomy view of the situation. For example, a closing stock should be valued at cost or net realizable value, whichever is lower. So when we value inventories, closing stocks, it compare the cost and the net realizable value, and we have to take the lower value because of prudence concept. Excessive application of this convention leads to secret profit or earning management and distorts the actual position and performance of the firm. Some managers are abusing this concept. Modern accounting thoughts shifted somewhat from the principle of conservatism. Right now, they move from the new theories entering in the accounting to overcome the problem in it. Full disclosure. So whatever the informations which influence the uses of financial statement, that information should be disclosed. right? So whatever the informations influence on decision making, that should be disclosed. It's called full disclosure concept. All information which is of material interest to proprietor, creditor, and investor should be disclosed in accounting statement. So this very much important in the context of model companies where management is separate from acts operations as an agent of the ownership. Materiality. I have explained what do you mean by materiality in the previous session. Some importance, no? So whether something should be reported in the finance statement will depend on whether it is material or not. The term materiality is subjective. So it's depends on the situation, depends on the people, depends on the user. Accountants should record an item as material even though it is of small amount if its knowledge seems to be influence the decision of property or auditor or investor. Example, commission paid to sole distributors. So this information may be important, but the amount may be less amount. But in the for decision makers, this information is crucial. So therefore, it's material, regardless the amount. Objective evidence concept. Objective evidence concept. So accounting, uh, this, the preparation of financial statement, accounting entries should be based on the evidence, based on the evidence, based on the source documents, not on subject matters. Objectivity connect suggests reliability, trustworthiness, and verifiability, which means that there is some evidence in ascertaining the correctness of information recorded. Entries in accounting records and data recorded in financial statement must be based on objectively determined evidence. So this helps maintain confidence of many users of financial statements. Invoices, vouchers for purchase and sales, bank statement for amount of cash at bank, physical checking of stocks in hands are some objective evidence capable of verification. Even where subjective matters play a role in accounting, for example, estimation of depreciation, bad debt provisions, so these are the subjective matters. There is no source document for that kind of decisions. Should be much based on objective evidence as much as possible. Consistency. They have to consistent over the period of time. Consistent judgment. Consistent rule of depreciation method. Consistent method of valuation. Right? They have to use the same method for a period of time continuously, right? Consistency. Accounting rules, practices, conventions should be continuously observed and applied. They should continuously applied. That is, this should not change from year to another. For example, last year they have used straight line method. This year they are going to use reducing balance method. Next year they are going to use sum of digit method. No, this is not consistency. This is important and help for comparability of the performance of the same organization in the past and other similar organization in the industry. Consistency implies external consistency and internal consistency. Consistency. Accountants should follow consistent accounting policies. Adequate disclosure of information should be ensured if any changes of accounting policies which can be affect the comparability of financial statements. So this concept is closely related to the going concern concept. Asset is recorded in the books at the price paid to acquire, purchase it, and that this cost is the basis for all subsequent account for asset. Let's see the impact of cost concept on accounting. Assets are recorded in historical cost. Some assets for which no cost was incurred to acquire it will not be reported in the books of accounts. Knowledge, human assets, they are not reported. So dual aspect, it means a double entry system. Dual aspect concept. Every financial transaction involves twofold effect. So getting of a benefit and giving of the benefits. Debit credit. Every transaction has a debit credit. So the superstructure of double entry system of accounting is based upon this aspect concept. So impact of dual aspect concept of an accounting. So every debit must have a corresponding credit, and every credit must have a corresponding credit. So total asset is equal to total equities if assets are financed fully by the owner, or total asset is equal to equities and liabilities. Accrual concept, what do you mean accrual? The prepaid expenses, advance payments, payables, accruals. Revenue is recognized when it is realized. That is when the sale is complete or services are rendered, and it is immaterial whether cash is received or not. Similarly, expenses are recognized in accounting period in which they help in earning the revenue regardless of whether the cash is paid or not. So what are the impact of accounting? The impact of accounting period concept on accounting. So actually, the impact of accrual concept period on accounting. So outstanding expenses and outstanding income are taken into consideration while preparing the financial accounts of the business entity. Right, I think the presentation is over. If you have any questions, you can post your questions and you can ask.